Microsoft just paid $200 million for carbon credits. Amazon dropped $10 billion. Google, they're buying everything they can get their hands on. Here's what they're not telling you. The carbon credit market grew 164% in 2021 alone, and most individual investors have no idea this gold mine even exists. While everyone's debating Tesla stock, smart money is quietly positioning itself in the world's newest asset class. A carbon credit investment strategy isn't just about saving the planet anymore. It's about making serious money while companies scramble to meet net zero commitments. The numbers are staggering. McKinsey projects the voluntary carbon market will hit $50 billion by 2030. That's a 15x increase from today. But here's the kicker. Most retail investors are locked out of the best opportunities because they don't understand how this market actually works. Here is exactly what to discover. 3 specific ways to profit from carbon credits, including one method generating 40% annual returns for early adopters. The real risks everyone glosses over. Which sectors offer the highest potential? And exactly how to build a carbon credit position without falling for the greenwashing scams plaguing this space. This isn't about tree hugging. This is about following the money. Let's start with what carbon credits actually are, because the financial media gets this wrong constantly. A carbon credit represents 1 metric ton of CO2 either removed from the atmosphere or prevented from entering it. Companies buy these credits to offset their emissions when they can't reduce them directly. Think of it like pollution insurance. Every major corporation has committed to net zero emissions by 2050. They literally cannot meet these goals without buying massive quantities of carbon credits. This creates guaranteed demand for the next 3 decades. But here's where it gets interesting. The supply side is constrained. Creating legitimate carbon credits takes years of verification, monitoring, and certification. You can't just plant some trees and start printing money. The good projects are scarce, and that scarcity is driving prices through the roof. Research from Bloomberg NEF shows high-quality carbon credits trading at $50 or $100 per ton, up from $5 or $10 just 5 years ago. The best projects are commanding premium prices because buyers are getting pickier about quality. This is classic supply-demand economics playing out in real time. There are 3 main ways to access this market as an individual investor. The first is direct investment in carbon credit projects. This means putting money into reforestation, renewable energy, or carbon capture ventures that generate credits you can sell. The second approach involves publicly traded companies with significant carbon credit exposure. These are businesses that either develop projects, facilitate trading, or hold large credit portfolios as assets. The third method is through specialized funds and ETFs that have launched to capture carbon market growth. Each approach has different risk-return profiles and minimum investment requirements. Before imagining easy profits, the elephant in the room needs addressing. The carbon credit market is riddled with problems that can destroy your investment overnight. A recent analysis found that over 90% of rainforest carbon credits are basically worthless. Projects that claimed to prevent deforestation were happening in areas that weren't actually threatened. Other projects counted trees that were already protected or would have grown anyway. Then there's the permanence problem. What happens if those trees planted burn down in a wildfire or get cut down by a new government? The credits vanish, but the CO2 goes right back into the atmosphere. This isn't meant to scare anyone away. It's meant to make investors smarter about where they put their money. The key to profitable carbon investing is quality over quantity. The projects worth backing have bulletproof verification, third-party monitoring, and what experts call additionality. Proof that the carbon reduction wouldn't have happened without the project funding. The gold standard projects right now are in 3 sectors. First, direct air capture technology. Companies like Climeworks are literally sucking CO2 out of the atmosphere and storing it permanently underground. These credits command the highest prices because the carbon removal is measurable and permanent. Second, blue carbon projects. These involve protecting coastal ecosystems like mangroves and seagrass beds that store massive amounts of carbon in their soils. The science is solid, the monitoring is straightforward, and the co-benefits for marine ecosystems create additional value. Third, enhanced weathering projects. This involves spreading certain rocks on farmland that naturally absorb CO2 from the atmosphere while improving soil health. It sounds boring, but the returns are anything but. For direct project investment, minimum investments run from $100,000 to $1 million, with expected returns of 15 to 40% annually over 5 to 10-year periods. But development risk, regulatory risk, and technology risk all come with that territory. The easier entry point for most people is through public companies. Brookfield Renewable Partners holds one of the largest portfolios of carbon credits from their renewable energy projects. Their credits are essentially a byproduct of power generation, creating a double revenue stream. Microsoft's carbon removal investments aren't just good PR. They're positioning the company to benefit as carbon prices rise. They're buying credits now at lower prices and will benefit as scarcity drives values higher. But the real opportunity might be in the infrastructure companies nobody's talking about. Carbon credit trading platforms and verification companies are the picks and shovels of this gold rush. They make money regardless of which specific projects succeed or fail. Companies like Xpansiv operate the world's largest carbon credit marketplace, taking a cut of every transaction. The trading volumes are exploding. Daily transaction values have increased 50-fold in just 3 years. These platform companies are generating recurring revenue from a market that's mandated to grow. Now for the risks they don't mention in the promotional materials. Regulatory risk is massive. Governments can change the rules overnight, making certain types of credits worthless. The EU announced stricter requirements that wiped out entire categories of credits. Price volatility is extreme. Carbon credit prices can swing 30 to 40% in a single quarter based on policy announcements or supply disruptions. This isn't a stable bond investment. It's a commodity play with all the associated risks. Geographic concentration is another concern. Many of the cheapest credits come from developing countries with unstable governments or weak legal frameworks. Political changes can destroy project viability overnight. But perhaps the biggest risk is reputational. As more fraudulent projects get exposed, buyers are becoming increasingly selective. Credits from questionable sources are becoming unmarketable, regardless of their technical validity. Download our free AI Investing Starter Kit. It includes a carbon credit quality checklist covering every verification standard worth knowing before committing a single rupee. Link is in the description below. The carbon credit market is evolving rapidly. New technologies like satellite monitoring and blockchain verification are solving many of the fraud and transparency issues. Machine learning algorithms can now predict project success rates with increasing accuracy. Institutional adoption is accelerating. Pension funds and insurance companies are allocating billions to carbon credit strategies. When institutional money flows into a small market, prices tend to move dramatically. Here's something most analysts are missing. The carbon credit market isn't just about climate compliance anymore. It's becoming a hedge against inflation and currency debasement. Carbon credits are tied to physical assets, forests, technology, real infrastructure. As central banks print money, hard assets tend to maintain value. Carbon credits are the newest addition to the alternative asset category. The correlation between carbon credit prices and traditional financial markets is near zero. During the 2022 stock market decline, many carbon credit investments continued posting positive returns. This diversification benefit is attracting sophisticated institutional portfolios. So what's the actionable takeaway? Start with education and small positions. The Invesco MSCI Global Climate Change ETF provides broad exposure to companies benefiting from climate transition, including carbon credit exposure. For direct carbon credit investment, Platforms like Patch and Cloverly allow smaller investors to purchase verified credits starting at just a few $100s. This lets you learn the market dynamics without massive capital requirements. This is a long-term play. The biggest profits will go to investors who can hold positions for 5 to 10 years as the market matures and regulations solidify. The companies making serious money aren't day trading carbon credits. They're building portfolios of high-quality assets and letting compound growth do the work. The carbon credit market represents one of the largest wealth transfer opportunities of our lifetime. Trillions of dollars will flow from carbon-intensive industries to carbon-negative projects over the next 3 decades. The question isn't whether this transition will happen. It's already happening. The question is whether you'll position yourself to benefit from it or watch from the sidelines as early investors capture the outsized returns. For a deeper look into alternative investments most people miss, the next video covers water rights investing, another climate-related opportunity generating massive returns for those who understand the fundamentals. That video is queued up on screen right now.